Hello, and thank you for joining today's webinar, Spotlight on North America. Banks and credit unions need to promote customers' financial well-being. My name is Jim Young, and I'm the Content Marketing Manager here at Personetics. I'd like to welcome our guest speaker, Peter Wanamaker, Principal Analyst at Forrester. And Peter will be joined by Jody Baggett, President of Americas at Personetics. First, some housekeeping notes. Today's webinar is being recorded and will be sent to you shortly after the webinar is over. And we'll be taking questions throughout the webinar, and you can submit them through your chat box. Questions will be answered at the end, but feel free to send them over as we go. And with that, I invite Peter to take it from here.
Thank you very much. Thank you, Jim, for introducing us, and thank you to Jody for joining me, and thank you to Personetics for having me and joining me and Forrester and doing this research. And I'm really excited to share it with all of you. So lastly, thanks to all of you for being here. So we're really excited to share with you some of the new research that we've uncovered, or research we've done, and the insights we've uncovered as part of that research. And yeah, the zeros, or the what we're zeroing in here is the necessity, not just the nice to have, of thinking about and promoting financial well-being and financial health within your customer base, and really ensuring that that drives growth for your bank, your credit union, whatever it may be. So I'm here to talk through the sort of spotlight specifically on the US and Canada that we looked at as part of this research. And we'll talk about a few different aspects of this research. We're not going to cover every single piece of it. There's a lot to cover, but as an audience member in this webinar, you will also get the companion North American report. I'm really looking forward to you reading that, and you can get some more insights from there. And we're going to highlight some of the key pieces of information that we uncovered from there. So to give you a sense of what we're going to talk about today, here's our agenda. So first and foremost, we are in the teeth of a cost of living crisis. This is not exclusive to North America, not exclusive to US or Canada. It is particularly pronounced among some segments, right? Lower income in the US is particularly hit hard. But it is truly a global crisis. It's one that is largely caused by and largely evident in inflation, but there are other aspects to it. And even if, God willing, inflation starts to slow, we're going to be feeling that the pain of that, and our customers, your members, your prospects will be feeling that pain for a long time. As a result, you can no longer just offer services to customers, right? Banking services are really valuable, but it is still necessary, not sufficient. You must, in order to grow, must strengthen their financial well-being, and then find ways to ensure that you're able to promote their financial well-being, their financial health, and therefore drive business growth for your firm. And a key point here, and this is evident, I mean, we saw this from banking executives, and we, Forrester, have seen this in our wider research. If you don't, others will. That competitive problem, or opportunity for many of you, is a very real part of the landscape. Our research shows that financial well-being is a real opportunity, even if you were in a vacuum with your customers, but you're not in a vacuum. And that's really driving a lot of our recommendations out of this research with Personetics. And finally, we're going to talk about the fact that creating those personalized experiences, improving financial well-being, will mean really rethinking, adjusting, at least to some extent, your business and operating models as a business, as a bank, as a credit union, as a banking provider. So without further ado, let's dive right in. So as I said, we are in the middle of what we at Forrester are calling a cost of living crisis. We're seeing 40-year high inflation, and that's not it, right? So this is driving up the cost of living across the US. This is also evident in Canada. A majority of US customers and a majority of Canadian customers are feeling the effects of inflation. And this is especially pronounced and especially acute within the lower income groups. In this case, when we looked at the lowest quintile. So this is really evident, and it's causing pain. And as a result, it's putting financial providers in a tough spot. What we've seen, again, in our wider research, is that last year, 2022, for the first time in 4 years, trust in banks dipped. There, we see this in our customer experience index, in our trust index. Banks are slipping when it comes to the trust that their customers have in them, right? It's not an all-time low, but it's the first time it's slipping since the pandemic started, and actually since a little bit before that. Now, a little bit of this can be accounted for when you look at things like just returning to some semblance of normalcy, or a quasi post-pandemic, or for some people a post-pandemic life, right? I mean, we saw a little bit of safe harbor happening, the effects of a safe harbor happening in our customer experience index for banking, for traditional banking providers, especially in those first 18 months or so of the pandemic. But it's a bigger problem than that, in part because it's dipping since before that time period. It's some of it again is the bite of potential recession, of certainly really sky high inflation for multiple quarters. As a result, banking providers, including credit unions, need to do more to help their customers navigate this crisis, and in doing so, regain their trust. Some of this is about reassurance. Some of this is about appropriate support, the sort of day in, day out aspects of having a banking relationship. Some of it, though, is bigger, and that's where on the right-hand side you see two of our other takeaways from this research. Innovating with next generation money management capabilities. And there's a reason it's a little puzzle. It's an icon, but it's often about the integration of those money management capabilities. We'll talk a little bit later about the problem of cognitive load for the customer. If the customer has to do work, right? And some of this is user experience friction, but some of it's bigger. It's sometimes emotional load, or what we call sort of as an umbrella concept, cognitive load, that affects their willingness to use those money management capabilities and to get value out of money management capabilities. And then the last one on the right-hand side here is, as a bank, as banking leaders, credit union leaders, you need to be ensuring that your strategies, your business strategy, your CX strategy, customer experience strategies, your digital strategies, your product strategies are data-driven, customer experience focused, and tech-enabled. And we'll talk through some of the work that you need to do as a business leader inside a bank or credit union to accomplish these things. But this is what we're seeing. It's part of a broader shift. And when we look at the research we did with Personetics, when we look at our wider research here, we see that there is a fundamental shift happening, and we've called it a shift towards financial well-being. It's not a new concept, and this shift is not new. It predates the pandemic. It predates that dip in trust, but it's really about earning trust, deepening loyalty, and ultimately then driving business growth. And on the right-hand side, we have just a sampling of some of the journeys and use cases that we see as part of, and that our research shows as part of, customers' holistic financial health and their ongoing, which is really a lifetime part of their experience, their financial well-being. So things like understanding how to invest. Yes, there are active traders and investors out there, and some of them are your customers, but a lot of them are not. And something that fintechs have done often quite well is offering easier to understand, better explained investing tools, even if they're the same or actually slightly worse or inferior investing tools. Planning for retirement, these are the big items. Affording credit, the concept of credit, this is all tied into their broader understanding, because a lot of this is about awareness of financial health, what it even means in financial well-being going forward. So I want to share with you some of the crucial insights we saw from the work we did on behalf of Personetics. Before I get into those, I do want to share with you quickly on what this methodology was. So late last year, we were commissioned by Personetics, working with Personetics to evaluate the state of digital money management. We did this across the globe. All the data you're seeing in here about the methodology and in the subsequent slides, the rest of the ones I'm going to share and any insights I'm sort of talking over come from North America, so Canada and the US. So this is what we looked at. In terms of what we saw, I'm going to share with you a bunch of insights. The first one I want to give you is this. Banks, credit unions, executives and leaders and managers, by the way, and teams at banks and credit unions want to do better. They are looking to improve their user experiences. They're looking to design hyper-personalized customer interactions. They want to offer the kind of next-gen digital money management that's been, let's be honest, has been the dream for 20 years and was non-existent 20 years ago, incredibly poorly integrated 10 years ago and clunky, still often under integrated or poorly integrated, and routinely a clunky part of the experience, but they want that. So when we ask them about which initiatives are critical or high priority, right, you see a majority saying, and this is the top two, either critical or high priority. So majority, 55% saying improve experiences of customers, 51% saying improving their digital services, right? I'd like to think that this would have been a majority anyway, but the pandemic put a spotlight, pun not intended, on the role of digital in in customers' experiences and in their relationship with you. And frankly, it put a spotlight on the role of digital in financial well-being, right? Financial well-being is a concept that doesn't require any mobile apps or websites, but more often than not, it is mobile apps and websites that are crucial parts of the work of improving a customer's financial well-being. So we do see some other things that certainly have an impact on how banks and credit unions are pursuing financial well-being and really just thinking about their business growth, right? So thinking about innovating, just shy of a 50% there, 47% in the middle there, just around half looking to accelerate their shift to digital business, and then some, quote unquote old school ones like reducing customer churn. This matters, and it's hard to do in this kind of rate environment, or can be harder to do in this kind of rate environment, and in a kind of chaotic economic environment. A lot of these matter even more so, right? Their impact is felt even more clearly by the bank I'm referring to. And another thing we found in this research was that banks and credit unions do offer money management. Now we're going to talk about the fact that we think in many cases those are underwhelming or some cases broken or poorly integrated, but almost 80%, so I'm looking at the bottom left here, 79% of all North American respondents, these executives and leaders at banking providers in Canada and US, say their bank already offers some sort of digital money management tools, right? That is in a sense good news, right? I mean, that most of them have dipped their toes in, right? It's almost 4 and 5. But when we look at the building blocks of financial well-being, which comes from Forrester's broader research on the right-hand side, really very few are in a place where they've put together a lot of these building blocks. And even bigger part of the story is, have they started to put them together and build really a holistic financial well-being offering, right? Have they started to think about financial well-being as a part of the overall relationship and as part of the customer's overall life? And the answer is no, right? And we know that's true for a number of reasons. We'll get into some of the challenges in a few minutes. But we also know that from this same survey that although almost 4 out of 5 are offering some sort of digital money management, we see this problem of adoption, usage, and engagement, or problems of adoption, usage, and engagement. 88% say that less than half of their customers are actively using these tools. And this is an old story, right? We're rolling this out, but they're not using them. There's major challenges. In fact, I'm going to spell out for you the 4 biggest categories of challenges that we heard about in this survey work, the work that we did with Personetics. But the bottom line here is, we have a problem we as an industry have a problem of recognizing the opportunity. As I said really early, you and your peers want to offer financial well-being offerings, want to offer digital money management, personalized, hyper-personalized digital experiences, but they're falling short. There's still a lot of hope here, right? I showed you some of that earlier, and there's still expected benefits from this. So if we can get over this hump, and I believe there is hope that we can get over it, we surveyed executives, leaders about what they expected to benefit from their business. And it's a pretty close clumping here. So I always mention this. So on the right-hand side, right, you can see this is what you perceived as the top business benefits of implementing better digital money management tools and technologies. And it's noteworthy that the 4 here are all within 3 percentage points of each other, right? 4 percentage points of each other technically. So that's telling me that there's a pretty wide set of possible benefits. And by the way, I think that's right. Forrester, based on our research, based on case studies we've done, and Personetics, Jody's going to talk about some of the work Personetics has been doing. It's evident that there are major benefits And there are positive knock-on effects to doing digital money management well, to really zeroing in on customers' financial well-being, promoting that, and ensuring, really enriching their lives with better insights, yes, but more than that, better tools that help them improve their financial health, improve their long-term financial well-being. So those are what we're seeing when it comes to the benefits. Now, although there are a wide array of perceived benefits, not just the 4 on here, but quite a few, there are challenges, right? And we saw this in our work with Personetics. So I'm going to talk through the 4 biggest ones that we saw come out. I'm going to show you some specific data points in the next 4 slides, but I want to highlight the top 4 as we see them when we were analyzing and interpreting this data. So there's a lot of different challenges, but top to bottom, here's what we see. Leadership alignment. And we're talking about within the banking organization, within the bank or credit union. There is a problem of alignment, often at the C-level, but it's not just the C-level's problem. In fact, unfortunately, it's sort of everyone's problem. And that's alignment around a number of different issues. That's part of the complicating factor here. And we'll get into some of the specifics here in the next slide. Number 2, an effective method of assessing and prioritizing the right technology and the right technology partner, right? So in the companion report that all of you will get for attending this webinar, our companion North American research report, Personetics is going to share that with you. You'll see that we talk about evaluating vendors and even something like a vendor scorecard for really being rigorous, because although financial well-being can sound like kind of a soft concept, can even feel to some like a sort of nebulous, it isn't, right? Ultimately, it has first of all, it's very real ramifications. And second, it requires very real specific capabilities. And they need to be the right match. And they need to be a right match with what you're trying to achieve and with what you already have. So thinking about really taking a rigorous approach to outsourcing, insourcing, and thinking about technology decisions and technology partnerships, that's something that's often standing in the way of better digital money management tools from the banks and credit unions, and really better financial well-being initiatives. Number 3 is the capabilities themselves, right? And capabilities is intentionally a word here. It is some of it is the technology, right? Which is part of what number 2 is trying to solve, or at least reduce the friction on. But it's bigger than that. It's the processes, it's org structures, it's the various things that allow you to deliver personalized and in some cases hyper-personalized experiences across touch points. And then the last one on here is one that's again, you're not alone. Every bank and credit union has some issues around data infrastructure, data quality, but the gaps between those that are solving these problems and trying to improve their situation and those that are slipping further short, falling further behind, is very real. So data quality and insights is the last one. So let's talk through some of these. So we'll start with the leadership alignment as a challenge. So this is the percentage, and you'll see we're using the same part of the survey to look at this slide and the next 3 slides that come after it. We're asking about how challenging different factors are in trying to create, implement, integrate a digital money management and personalization program. So nearly a majority say that it's a lack of clear, so 45% say it's a lack of clear, unified vision and alignment across the organization. Second, on the top right here, difficulty with ROI and business case. This should be a demand of C-level folks. It's impossible to detail every single revenue stream and dollar and cent that will come through, but there needs to be a realistic and defensible accounting of how this improves your business as a bank, as a credit union, whatever those business goals may be. You need to articulate and document what those are, and that difficulty is very real. And we work with folks on that. I'm sure Personetics works with folks on that. So yeah. So I'm thankful that on the bottom left here is not a majority, but still there's over a third say that lack of C-level support for digital customer experience strategy and optimization. And in 2023, even 37% is a disappointing figure to see. Not a surprising, but a disappointing one. And not, I spent all my time thinking about financial well-being and thinking about digital experience in banking. But it's not because it's 2023. It's because we see clear evidence that customers are doing more, wanting more, and expecting more through digital And yes, the pandemic was a major accelerant and amplifier of these effects. It's very real now. And then finally, on the bottom right here, the lack of leadership buy-in on personalization technologies, right? I think there's a view, some of this comes down to how they're utilized, and we can talk about this in the next couple of slides as well. But the view of personalization only through a marketing lens is perhaps understandable, but a major problem when it comes to really driving growth through financial well-being and really driving growth overall. So the number two challenge, or the number two category of challenges that we saw, comes down to the methods by which a bank, a credit union assesses, right? Really takes a rigorous, thoughtful, accountable, and that sometimes means documented approach to selecting the right technologies and selecting the right technology partners. So a majority say that there's a lack of alignment around build versus buy. This is an old, an evergreen question, an evergreen problem. But the fact that a majority are still struggling with it, it's not all build and it's not all buy, but navigating that and finding a way to have a rigorous, clear, transparent, accountable way of assessing what's build, what's buy is a big part of this. Lacking the right technology, I won't make you read through all of these with me, but the ability to find and assess the right technology and the right technology partners is a major challenge. And then lacking just the capabilities themselves, right? So some of this is around, sorry, I should have mentioned you, one of these, one data point is in two of the slides. It's the only time we do this, but that nearly 50% again on the left-hand side here are that lack the right technology for digital money management or for the right or hyper personalization or a personalization program. That's a major factor. And then broader digital transformation initiatives. And I'm a bit sympathetic, right? Jody and I can talk about this a little bit later. There's a sort of boiling the ocean problem to some banks and credit unions' digital transformation goals over the last 5 years, for some even the last 10 years. And that's, that is something to be aware of, and I'm even sympathetic to, right? And I'm talking about sympathetic to your fellow stakeholders who feel like, the bank's trying to do everything and just switch to a digital bank. And yet it's not an excuse for falling short when it comes to solving customers' financial well-being issues, sometimes acute ones around cost of living and inflation, sometimes broader ones around their life goals, right? And figuring out how to navigate their financial health and improve their financial health. Digital is part of that, and falling short on that, lacking those digital capabilities really inhibits, and in some cases prohibits, efforts and progress on financial well-being. And then the last one on here, data, right? Data is a major challenge. Data is a challenge for every industry. The good news for banks is they have lots of data, a lot of first party and even some zero party, and you as an industry, we as an industry, are pretty good at getting, holding, and mostly keeping secure data. The problem is sometimes quality issues and integration issues, and you can see that evident here. So 51% say a major challenge is integration with marketing, CRM, and other legacy systems. And those legacy systems aren't going away tomorrow. So if you want to improve customers' financial well-being, you need to solve these problems. And it's a major challenge, an understandable one, but a surmountable one. And then lack of quality data, issues around limited data standardization. A lot of this comes down to data infrastructure, data governance. It is not something any one person or one team can solve alone, even if you have a chief data officer. But it's one that is necessary. It's a precondition for success in personalization, in digital money management, and in broader financial well-being efforts. And then when we looked at this survey, with the work we did on behalf of Personetics and the work we did analyzing that data with Personetics, we came away with a more fundamental shift that's happening, right? So there's a fundamental shift towards financial well-being as an opportunity, as a necessity for banks and credit unions. As a result, there's a fundamental shift that we're seeing happen around banks and credit unions' business and operating models. And what we're talking about is how you make money and how you operate, how you run as an organization. And it is not that you need to flip to, you're not trying to become a streaming service or flip the script that dramatically. What we're thinking about, though, is really making digital money management a priority. Thinking about integration of digital money management tools and the positive business effects that has, business outcomes or impact on business outcomes. Overhauling your objectives, your revenue models, in some cases your revenue streams, and then thinking about frameworks for informed tech decisions, right? So this is a lot of what we talked about. It's the inverse of the challenge we talked about just a few slides ago. Being consistent and rigorous about about the principles and methods you use for selecting technology, and then selecting technology partners. And this is some big stuff, right? And I don't think anyone at a bank or credit union who takes financial well-being seriously, and I believe if you're listening to this, if you're listening to me and Jody today, I believe you that you're taking financial well-being seriously, or you want to, and you want your organization to. You need to be thinking about these more fundamental shifts in how you make money. That's individual revenue streams as well as the overall business model, and then how you run as an organization, how you assess and make decisions around technology, what your objectives are, etc. So yeah, I'm really excited to talk more about this. And with this, I'm going to pass it. I'm going to say thank you to all of you, and I'll still be here listening. And then Jody and I will answer some questions in just a few minutes. And with that, I'll pass it over to Jody.
Thank you, Peter. I really want to applaud you for the research that you did and the insights that you shared around the current state of the environment around digital money management tools, the challenges around being able to do it better, the payoffs around being able to do it more effectively, and then also some of the capabilities to embrace as well. I think it's very powerful insights. Let's take a step back, though, and try and look at the current environment. We believe that during this time of transition, of inflationary pressures and rising rate environment, we're very likely to see greater disparity between leaders and laggards, and not just in terms of capability, but in terms of hard financial metrics. So what's contributing to that? One is the rising rate environment. It's putting more money in motion. It's prompting customers to make choices with where they're putting their money and who they're developing with relationships with. Secondly, there's an accelerated shift to digital in terms of digital behaviors, sales activities, service activities, and that's putting more pressure on FIs to invest more heavily in digital capabilities. Thirdly, as much as some banks would like to compress the pace of innovation, some are saddled with legacy technology stacks, which will depress some of the pace around the desired state. And lastly, new points of distribution from fintechs, from embedded banking services, where they're picking off profit pools and delivering banking services that can compete with traditional banks. Now, as you pointed out, Peter, financial wellness is a key part of the solution, and we know that customer engagement is critical in this undertaking. You shared some of the potential payoffs. And in fact, our friends at McKinsey also did some analysis, and they said that leading banks that have over 30% engagement around money management and PFM capabilities show 175% higher sales per user and substantially higher monthly logins. Now, the challenge is that historical money management and PFM have not demonstrated this kind of engagement. So where to go from here? Personetics also conducted research with 5,000 consumers of banks and credit unions, and the results there were very much corroborating of what Peter shared from Forrester. 4 out of 10 customers want to see that personalized advice and money management support delivered through their mobile banking app. 1/3 of customers said, "You understand my cash flows. Help me save better. Give me programs that'll help me save better." Over 1/4 of them said, "You should understand me better as a customer and deliver me recommendations that will improve my financial well-being in the forms of products and tools." And a startling number, over half, said that they may switch to a competitor for better money management capabilities. So this reinforces some of the case for action that Peter laid out in his research. And we believe at the heart of this is delivering not just financial wellness, but I'd like to introduce the concept of personalized financial wellness, recognizing that financial wellness means something different to an affluent customer that's trying to build wealth versus a marginalized customer that's trying to make ends meet and is living day to day. They require different kinds of financial wellness at any given point in time, and certainly over the course of time as well. So we'd like to introduce this ecosystem, if you will, on delivering personal financial wellness based on these four components. The first is data enrichment and cleansing. That is enabling customers to understand transaction activity and what's important to be able to be aware of and take action on at this point. Second is delivering personalized advice in a proactive and intelligent way. Third is enabling customers to accomplish journeys or jobs to be done. And the last is capturing customer intelligence and propagating it across channels to be able to deliver unified advice across channels. So let's look at each of these four, starting with data enrichment and cleansing. Data enrichment and cleansing and categorization is fairly foundational. It is interpreting customer transaction data and then using it for future analysis around insights that are relevant to customers. It also helps customers understand and make sense of their transaction data, identifying who this transaction was with, the logo, the location, the website, thus providing clarity around where my spending occurred, how much spending occurred, and also reducing calls into the call center to understand those transactions and also dispute potential transactions that are confusing. The second aspect then is around personalized advice. And this is where the industry has started to take a significant ground and made significant strides, although there's still quite a ways to go. This involves delivering intelligent, proactive, contextual insights that are tailored to what the customer needs to be aware of and take action on at that moment. It could be around transaction monitoring, that is looking for anomalies in transaction activity. They're missing a deposit, or a deposit was lower, or this is a bill that's much higher than typical, or managing subscriptions. We all have potentially hundreds of dollars in subscriptions. Sometimes we have subscriptions, multiple subscriptions in the same category. And it's useful for customers to understand when a subscription is coming off a free trial and they're about to start paying $15 a month, and do they want to keep it? It's also useful for customers to understand how to better optimize their cash. Based on an understanding of cash flow, banks should be able to identify to customers, look, you're keeping more money in your checking account than you need to be able to cover your expenses over the next 30 days. So we invite you to move over $800 into your savings account, or by the way, open up a new savings account. And here's a deep link into the process to do so. And lastly, proactive balanced forecasting, where based on understanding customers' cash flow patterns, their scheduled activity, their recurring activity, and their patterns of activity, that they may have a cash flow issue 7 to 10 days from now, and inviting them to take action to ameliorate that condition in advance, rather than to deal with penalty fees at the time. And then making it even more current, one can also bring in inflation insights that are really relevant and contextual for the point in time that we have right now. We know that during a rising rate environment, customers will have more choices with their money. So let's introduce to them that we have products that can help you make more from your savings. That money that you're sending out to another institution, it can actually work harder with us. Or you've got rising rates around your current loans. We have lending options that may be more attractive. So this whole area is around personalized insights and advice. And we see many leading banks throughout North America and globally actually embracing this capability. This is a universal phenomenon around being able to deliver personalized insights that are relevant and intelligent and contextual for customers. And you can see here a number of leading banks. What you'll notice, though, is that the experience is quite different. Even if the underlying capabilities are similar, the experience in terms of how it's delivered, how you interact with your customers, even the branding is different. The branding experience is different for each of these institutions, actually. And so it's very powerful in terms of delivering the kinds of interactions to help customers better manage their day-to-day banking, but delivering it in a way that is right for your customer franchise and for your offerings as well. And this isn't just the domain of the biggest, most sophisticated banks. We now have the capability to deliver a more turnkey solution of enrichment, personalized insights and advice in a much more packaged way, and it's tailored for mid-sized banks. So it's a capability that the entire industry should be embracing. In fact, we believe that a basic version of this capability really will be table stakes by 2025. So I'd invite you all to embrace this kind of capability and see the power that it has with your customers. So the next step then is around journey delivery, or what might be thought of as jobs to be done. Now, we know that personalized insights can create a lot of value in terms of identifying what should I do right now. But customers have jobs to be done that they may be conducting over the course of 1 year, 2 years, 3 years. This could be around establishing emergency savings or manage their spending more wisely, growing their wealth, saving for a big purchase, or trying to improve their credit score, or trying to pay down debt. Any of these aspects could be appropriate for a customer based on their financial situation and the job they're trying to accomplish. So what's incumbent upon FIs is, one, to recognize the need. Second is to enable that journey with a tailored set of products, tools, programs that can help customers accomplish that job. And third, and most importantly, show customers how they're progressing towards achieving that goal, reinforce positive behavior, and then give them some options when they're not making progress as well. So let's share a couple of examples here around a few of these. We'll first touch on saving for a goal, then managing spending, and then paying down debt. Now, Ally Bank is a terrific company and has done very well in terms of gathering not just deposits, but also building client relationships. They have over 2 million customers now, and they've introduced a capability over the last couple of years called savings tools. And it's a very powerful capability. It involves savings buckets, in other words, savings envelopes, surprise savings that can help customers save more effectively. And they've publicly stated that 600,000 of their customers use some kind of their savings tools. And those customers are 2x more likely to have multiple Ally products. So it's very powerful outcomes when you introduce the right kinds of financial wellness tools that can help your customers accomplish a job. Second example we'll turn to is around helping customers manage their spending. Now, budgets have been around a long time. Perhaps some of you have budgets. But when you look at the adoption of those budgets, it might be 2%, 3%, 4%. It needs to be much, much higher. RBC has introduced smart budgets. It reaches out to customers in an intelligent fashion, to those customers that can benefit from the budget, invites them into a program, identifies for them what is the category that they should be budgeting for based on their historical data and their patterns of data, suggests a target for the amount, and then automatically tracks it for them in terms of their behavior as well. So you can see the difference. Peter talked about the issue of cognitive load. Through RBC's smart budgets, they've removed that cognitive load. They've made it very easy for customers to say yes. And as a result, they've had an order of magnitude greater adoption than some of the traditional numbers that you see with traditional budgets. The last use case around paying down debt. So let's say that through our data enrichment and cleansing, we recognize this customer has increased external debt. They're revolving their debt. And we've also have a verified source of income. We can actually see their income sources, and their income stability. So let's initiate a journey with them around paying down that debt. We're going to give them two options. One is we have a product that you can use to consolidate your debt, or enroll in a program and we will use our logic around understanding your cash flows to move money over, incremental amounts of money, to pay down that debt and do it in an accelerated fashion. So we'll invite them for this program. Let's start paying off your balance. And then we'll provide a tracker of how the customer is doing. And we'll acknowledge and celebrate their success in paying down that debt over time. So now just consider the dynamic now between customer and FI, where previously you may have just offered them a product, and now you're offering a combination of product, tool, program to help them accomplish a job over time, and demonstrating and reinforcing the progress the customer's made in terms of improving their financial well-being. The last step now is around connected channel intelligence. And this is where we see the exciting frontier for the entire industry. Because in many institutions, it's not just about the digital experience. There's a critical human experience as well. And we know that bankers can play a vital role in customers' financial wellness. But at the core, we need to have the right kind of customer intelligence and be able to deliver it not just through digital channels, but to banker channels and also into your MarTech stack for improved engagement and interactions with customers. What does this mean? So customer intelligence can take the form of all of these different attributes, because by enriching and cleansing data, you can reveal a very robust set of customer intelligence and deliver it throughout your organization. Is the relationship primary or secondary? What kind of transaction volume do they have with you? What's their trending around balances and total assets? The sources and the stability of their income, the volatility of their expenses, the number of cash flow issues they've had, whether they have capacity to save or invest every month. Where's that money going? Is it staying inside the institution, or do they have $1,000 a month leaving the institution for savings and investment vehicles? Are they revolving or transacting on their card? And their average spending as well. And then what kinds of loans do they have? Do they have debt consolidation loans, or do they have payday loans? All of this intelligence can be captured and then synthesized into specific events and opportunities. And part of that can be delivered digitally to the customer, but also to the banker and into your MarTech stack as well for customer marketing. So let's take a use case around how this may work. So again, our data enrichment and cleansing is telling us that this customer just had a new source of income or a salary increase or a job change. They are keeping excess liquidity in their transaction account, much more than what's needed to cover their expenses. And they're moving money outside the institution every month. So in the digital channel, we'll ask them if they're saving for a goal. We can also set an indication with them to say, look, do you want to set up an appointment with a financial advisor through the digital channel? But in parallel with that, with the financial advisor, we will arm them with this customer intelligence, all of this intelligence we just spoke of, and essentially a financial activity map showing where is the opportunity and why is this customer an ideal customer to engage around our wealth and savings offerings. And in parallel with that, we'll also take this intelligence and we'll populate it into your CDP or your customer data platform or your equivalent thereof. And as a result, we'll put in the income sources, the excess cash flow, the third-party leakage, so that as you're preparing then to market to this customer, that marketing can be much more personalized and much more intelligent as well. So you can see the power of customer intelligence improving the digital experience, banker productivity, and marketing conversion effectiveness as well. I'm fortunate enough to lead a podcast. It's called Banking on Innovation. I get to talk to some of the most exciting leaders across the industry. It's intended to be a casual yet thought-provoking kind of tone. And we speak with, invite guests that are leading customer-centric change in the industry. And Liz Wolverton from Synovus is one of those individuals. And she gave a great quote that I'd like to share. She said, this idea around connected channels or digital plus human, she said, I see it as a dance, a beautiful dance, that choreography between the digital and the human coming together. Very challenging to do, but very powerful to deliver on. And I'm sure you will continue to see innovation in this regard from Synovus and other leading banks moving forward as well. Last thing I want to say about financial wellness is that it needs to have teeth, just like anything. What you measure gets valued and gets delivered on. And I would invite the industry to consider, as part of a bank's balanced scorecard, to have a dimension for financial wellness. And if you'll permit me, I'd like to actually suggest what some of those metrics may be. Here's 5 of them that you should consider. One is the percentage of customers that have emergency savings set aside to cover up to 6 months of spending, their individual spending. The second is the percentage of customers that are able to manage their spending on a monthly basis without incurring cash flow issues. The third is a term which I've just evolved or came up with, which is net credit score, which is the cumulative credit score gain divided by the credit score decline, showing that, are you on a cumulative basis improving your customer's credit score? Are you taking action to help them do so? And then as a subset of that, look at percentage of customers that are creditworthy, because we know that customers that are creditworthy are going to be much better off in terms of their financial well-being. Fourth point is the percentage of customers who believe the bank improves their financial well-being. Now, this is an indicator as part of a branding experience. How much do they trust your brand in terms of, are you really making a demonstrable impact on my financial well-being? And the last one, which I think is very powerful, which is the cumulative net benefits you're delivering in terms of benefit savings to customers. And this can be collectively across ATM fees averted, cash flow issues averted, monthly fees that have been dismissed or avoided, and rewards received. And more importantly than just calculating or tracking it, convey it back to each customer in the form of a monthly insight. Convey to them, these are the benefits you receive by having a relationship with the bank. So I hope this kind of more thought-provoking approach around incorporating financial wellness metrics as part of your balanced scorecard allows you to engage a more executive and a broader audience around not just financial wellness capabilities, but also how to track it and to make it a key part of what your bank needs to deliver to be able to improve the value of the customer franchise. So how to get started on the progress and the journey? Hans Morris, who is the managing partner of NICA and actually was another guest on our podcast as well, thought had a very salient comment. He says, I don't see this as a technology problem. It's a leadership issue in organizations that innovate at pace. CEO and management team take ownership and are aligned on what they're trying to achieve. And I wholeheartedly agree. And Peter made this comment as well. It's not a technology issue. It's really embracing financial wellness as something that, and personalized financial wellness, as something that customers value and that has material and tangible gain for the organization, and involves a set of capabilities to embrace and a way of operating that is different and more intelligent and proactive, focused on helping improve customer financial well-being. And as a result of that, you will see a stronger customer franchise and better business outcomes. And the 4 steps that we've laid out here are starting with data cleansing and enrichment. Next, delivering personalized insights and advice. Thirdly, enabling journeys or customers' jobs to be done. And the last is propagating that customer intelligence across channels to create connected channel intelligence. So Peter started out by sharing the importance of digital money management, the current state of it, what the opportunities are to improve, what are some of the challenges that we have today, and then how can you embrace some new capabilities to be able to deliver against that. And I hope that I've shared with you a blueprint on how to consider moving ahead, where the industry is already going here, and the fact that it's really important for you to consider this a high priority and to deliver innovation on behalf of your customers around personalizing financial wellness, and that there's a massive payoff for those leaders that do it well, and they will see a greater separation between leaders and laggards enabled by improved financial wellness. So Jim, I'll turn it back over to you for questions.
Thanks, Jody. And yeah, some really thought-provoking stuff from both of you. And not surprisingly, that led to some questions from our audience. And we got time for a few here. So I'll start with you, Peter. This person wants to know, and you touched on this a little bit in your presentation, but they want to know, in your research, did you come across some specific reasons that banks gave as to why they thought their customers weren't using and engaging with their digital money management tools?
Yeah. So yes. So it's a good question. I always try to be respectful and answer the direct question as to what bank executives and leaders tell us as to why they think customers aren't using them, and I'll also expand a bit, or at least to sort of answer an adjacent unasked question, which is what we see. If that's not, if the reason they think isn't the main driver, what is? And sneak preview, there's something else there that we think is driving this, and I've already mentioned it. But first, the reason they give, banking leaders, and they're not wrong about this, but I think there's more to the story. But the main reason they give is about marketing, meaning not necessarily marketing. Sometimes it's the marketing team, but more the concept of are they selling digital money management capabilities appropriately or effectively, I should say, right? So we built this really cool thing, or we bought this really cool thing, or whatever it may be, or we integrated and implemented this, but then we fell short in terms of offering. And then there, like I said, there's something to that, but I don't think that sufficiently explains the lack of adoption, usage, engagement. So the biggest answer they give is about marketing, promotion, and then there's something to that. But again, I think that's a factor, but a relatively minor factor. What we see in our research is the more powerful driver, and it came up earlier in the call. It actually came up twice. Jody mentioned it. I mentioned it. The most powerful driver we see, or in this case, the most powerful inhibitor, is cognitive load. The cognitive load being placed on the end user to get the most out of, or to get anything out of these money management tools, to get the most out of personalized offerings, all of this. And that's for many of the reasons that Jody and I talked about, many of the challenges that I cited in the data that we got with Personetics, many of the commentary that and things that Personetics has seen and Jody mentioned. So cognitive load, we use that term we stole it from academia, but we use it very intentionally, because when we say cognitive load, we're not just talking about the work the customer has to do, filling in form fields and clicking on buttons, though that is important. That is, we see very clearly that friction, physical, having to type in a bunch of stuff decreases conversion rates, active usage, all that stuff. But it's more than that. Cognitive load incorporates manual workload. It also involves intellectual load, emotional load. So one thing I mentioned here is retirement planning. Jody rightly mentioned that there are jobs to be done and journeys that are bigger than one interaction. Retirement's one of them. Retirement planning and taking action for retirement planning. So when we look at retirement planning calculators, the most common first question, even from a good or at least popular retirement planning calculator, is how much do you think you'll need to comfortably retire? That's what they're asking the end user, the person taking this calculator. And I'm talking about, and I'm not pointing out any one particular, that's the most common first question on a retirement calculator. That's, first of all, the person doesn't know. There's an intellectual sort of part of that, but there's also an emotional load to that. That's what I'm coming to you to do. So sorry, probably took a little longer than I meant to answering this question, but the reason that banks give and credit unions give is about marketing, and there's something to that. But the bigger one is the cognitive load, which often is about alignment, leadership alignment, which I talked about, technology integration, and technology partnerships.
All right, Jody, this next one's for you, and this one sounds like it comes from someone who's had a little bit of a difficult experience with this. But that's just, if my bank has already invested in digital money management tools and we're not seeing engagement, which again, Peter's numbers would indicate this person's not alone, then why should we double down on this with additional investment? Am I in danger essentially of throwing good money after bad?
Yeah, Jim, it's an important point because we know that traditional personal financial management tools have been around a long time, and they have sometimes they have cool looking user experience, but haven't met the outcomes, haven't received the engagement for many of the reasons that Peter talked about, and haven't delivered against the business outcomes. So it's important to demarcate the kind of the traditional PFM solutions versus what we're talking about now, the data-driven personalization and personalized financial well-being or financial wellness, where you're using data and analytics and a deep understanding of customer activity to help them better manage their day-to-day banking. You're using the intelligence to identify when they should be in a different product. Note, I'm saying actually when they should be in a different product, meaning they should be in a new product that you are offering or you're advising them to consider. The difference here, though, is that you're providing evidence as to why they can benefit from that. So there's a strong demarcation between traditional, which is historical, backward-looking, not very intelligent, kind of summarizing expenses, versus forward-looking, proactive, intelligent, where customers can really see that the FI is looking out for me, looking out for my best interests. And as a result, I'm much more inclined to take action on the advice they're suggesting and appreciate when they're giving recommendations that those solutions are in my best interest when will help me save and improve my financial well-being. And of course, by doing so, you also can deliver a business case of key metrics and strong economics that can not just have your chief digital officer and your head of retail pleased, but your chief financial officer as well.
Okay, that's great, and it touches on a little bit this last question I had for Peter, and then Jody, I'll try to get one more in for you before we wrap up. Peter, this person wants to know, but basically says, look, our executive team continues to view money management as a nice to have. They think it's great, but they just don't, there's always something else on their priority list that comes in above it. So this person is asking you, how do I make the case that this should actually be top priority?
It's a great question. So I'd give three answers to that person. I am giving three answers to that person, and hopefully to others. So one is there's a framing. So it's framing, competitive pressures, and business case. Those are three. So I'll talk through all three of them. So in terms of framing of this, and I don't mean framing, I mean sort of I'm not talking about wordsmithing. I'm talking about the framing of this. Why it matters is the push isn't money management capabilities. The push is, as we outlined in this presentation and in the research we've done, it's about customers' financial well-being, right? That is, and what then drives deeper relationships, deeper engagement, and growth for you. So that's the first thing I'd say is that framing of, I think it's true if you just say it is some sort of money management tool that we want on our website. Yeah, that is probably that sounds like a nice to have because that's just something on there. If you're accurately positioning it and thinking about it as part of a broader financial well-being strategy, that's a big difference. Number two maybe should have been number one, but I'm listing them. I don't know in what order, but the burning platform is often the competitive pressures. In one of the first slides I showed in this presentation, if you don't do this, someone else will. And yes, there's a small army of fintechs, and they don't have to it doesn't have to be one of them that dominates. And by the way, there's also lots of traditional competitors and some strange adjacent disruptors like Apple that are in here that if you don't do this, someone else will. So again, the executive team, the board might say, well, we don't believe this. We think this is a nice to have. And the answer is, if we existed in a vacuum, yeah, maybe it would be nice to have. I still don't think that's true, but maybe we could consider that argument. We don't operate in a vacuum. We operate in a highly competitive space, or at least a competitive space, an increasingly competitive space. So those competitive pressures are number two. Number three is the business case, right? It doesn't need to be perfect. It needs to be understandable and defensible. There is value, inherent value, and long-term value in saying, this is why digital money management, personalization, financial well-being efforts will improve our business outcomes. And quantifying it, even if it's imperfect. As I said, it doesn't need to be perfect. It needs to be understandable and defensible.
All right, that's great. I'm going to try to squeeze in one more question here for you, Jody, and this is one I'm sure you've gotten from different parties in different situations. This person says, listen, leveraging customer data sounds great in theory, but I'm constantly being told by our data folks that they need more time, a great deal of time, to get all that data organized and clean before they can put it to any use. How do I get around that hurdle?
Well, I love this question. My Yogi Berra quip around this is that 90% of bank executives think their data is worse than average. And it seems like a bit of a badge of honor to say that your data is poor quality. But it's understandable that this is a real challenge, and it's been a challenge for a long time. And I think that has tainted people's perspective around the current state of the environment and what can be done. And we certainly applaud the efforts around data transformation and getting data to a better place, improving the quality, making it more accessible. But what we disagree with is that is a multi-year effort, which needs to put your business outcomes and your business gains on hold. And that's why we believe that there are very strong use cases to be delivered, even with your current data environment, where you can extract and cleanse transaction data from its current source. You can enrich that data, you can categorize that data, and you can deliver real business value in the form of insights, advice, in the form of customer intelligence, and do it in such a way that drives value while you may be undergoing some broader data transformation effort. So I believe that this is it's really important for Chief Technology Officer and the business head to come together and agree on not just a data transformation effort, but also what can we do with data in our current environment that's going to drive real value. And we firmly believe, and we've seen it with dozens and dozens of implementations across the world, all of which have banks that have different kinds of data environment, where you can extract real strong business value and make a strong customer impact just through using your current data environment and using some of the techniques that we've espoused.
That's great stuff, Jody. Wish I could keep asking you guys questions, but we're really pushing it on our time at this point. So instead, I just want to take the opportunity to thank Peter and Jody for really interesting, thought-provoking discussion. And want to thank you to our audience for joining us. If we didn't get to your question in the Q&A, we will reply to them via email. And a reminder that you'll soon be getting a recording of the webinar, as well as a copy of the report that accompanies this. And again, if you have any additional questions, please feel free to submit them to marketing@personetics.com. And again, thanks for listening.